But I told you the promissory note is the evidence of the debt and the promise to pay it back. And so it would contain all of the terms being the interest rate, how many years, right? Of course, the promise to pay, as we said, the signatures of the borrower accepting this promise. This is really should be thought of as an IOU. And it is a type of contract and it is in writing, but it is not typically recorded. Not saying that it couldn't, but it's typically just in writing. And so you've promised to make these payments back plus interest to the bank, and the bank can and typically does sell this IOU off, this promissory note, to other banks, sometimes even at less than face value for immediate, capital. We'll talk more about that in a little bit when we get into the secondary mortgage market. But there are a lot of times very unique things that get added into this promissory note. We call them clauses. So if speaking of the holiday season, right, if you've ever seen the movie The Santa Claus with Tim Allen, it's a play on words, right? Because Santa Claus, but the Santa Claus being the addition to a contract. And so that's what a clause is. It is special language within a contract. And so these promissory notes very often contain clauses. Nothing to do with being Santa, but things to do with your loan. And so the first most common clause that is in all of these promissory notes is called an acceleration clause. Folks, what does it mean to accelerate? I like it. Yeah. Tara's like, yeah, speed up. That's exactly what it is. Go fast, moves fast. Yeah. The acceleration clause, folks, you have 30 years to pay it back or whatever. But an acceleration clause is if you default in any way, shape, and form, they're going to speed up the maturity date. You didn't owe us all the money until 30 years from now. However, because you screwed up, you owe us everything right here, right now. That is the acceleration clause. And so, folks, that's what happens in a foreclosure. If you default, you miss payments, you don't get approval to do something, if you default in any way, shape, or form, this acceleration clause is going to have the banks sending you a notice that the total balance is due and payable immediately. And if you can pay it, good, you're done, walk away, and you keep your house. But most people cannot pay it in full, and so that's where the foreclosure comes into play. The total balance is due and payable immediately because you messed up, and now, because you can't pay it, we're going to foreclose on you. So that's an acceleration clause. Speeds up the maturity date from what it was to right here, right now, all of it. Now, acceleration clauses exist in every single loan. I mean, every single one. I can't think of a single one where it would not be present. A prepayment penalty clause, folks, is exactly what it sounds like. It is where they are penalizing you if you pay off the loan early. Why? Because the banks like their interest. And so if you were supposed to pay for the next 30 years, they would have gotten 30 years of interest. But if you pay it off early, they're not going to get all that interest. Now, this is not especially common in mortgage loans. And in fact, it's prohibited on government-backed loans. We're going to talk about this more in a second, but FHA, VA, and USDA loans are prohibited from having prepayment penalty clauses. Also, it's prohibited in North Carolina on first liens of $150,000 or less, but it's not a very common thing because if we're being honest, most of us are not going to win the lottery and pay off our home loans in 5 years. It would be nice to think that we would. Now, sometimes there is certain things with how fast you can refinance with these prepayment penalty clauses, and it would be outlined within the promissory note and the terms of the loan. But that's all a prepayment penalty is. The prepayment penalty clause is where they charge you some type of fine or fee or additional interest because you paid off the loan early. So sometimes it may say, if you pay it off within the first 5 years, you owe us $3,000 or something. Some type of penalty for paying the loan off before its maturity date. That's it. And I told you, they are prohibited, meaning not allowed in government-backed loans. Now, the last one is called the alienation clause. Folks, you better know what the word alienation means. We had an entire section on it earlier. What does alienation mean? To separate, to leave alone. I mean, both of those are accurate, but what were we specifically talking about when we were talking about alienation previously? Bree says your house gets taken. That's an example. So remember, alienation is removing yourself from your ownership. And there was voluntary alienation and involuntary alienation, right? Alienation is removing yourself from your ownership. And so voluntary would be selling your house, gifting your house, willing your house, right? Involuntary, we talked about eminent domain, escheat, adverse possession. Remember these conversations about removing yourself from your ownership, either by choice or not. And so that's all this is. An alienation clause, also sometimes referred to as a due on sale clause, says if you remove yourself from the ownership of the property, you have to pay the full balance immediately. Folks, this is the clause that exists to make a loan not assumable. Because if this exists, if you sell your house to somebody else, that means this loan needs to be paid off and the next person is going to have a new loan. But if your loan did not contain an alienation clause, that means somebody else could assume your loan, meaning take over your loan. So if an alienation clause is present, your loan is not assumable. Yet again, alienation clauses are prohibited on government-backed loans, which means all government-backed loans are legally assumable loans. Somebody else can take over your loan if it's a government-backed FHA, VA, and USDA loans. So acceleration clause, prepayment penalty clause, and alienation clause. So when we're dealing with a promissory note, I told you it's basically a really fancy IOU. And I told you very often they will sell those off to other banks to free up capital so they can continue to lend. And so when we call it a negotiable note, means the note can be transferred or sold off to other people. Of course, non-negotiable notes are only payable to the named person, not the common place, right? Non-negotiable notes are the rare kind. Negotiable notes are the most common. There are some banks that will service their loans for the entire term, but that's very seldom. Most of them are going to sell them off at some point down the line, whether it be immediately, whether it be 10 years or whatever. It's a very complex world in the financing side of things. I don't stress too much about this second note here. It says some states use a bond in lieu of a promissory note. A bond is basically a guarantee that something will be paid. It's almost like a business insurance policy, if you will, for lack of a better way of putting it, where you would have to get a bond issued by a surety company that basically says that, they're assuring that it gets paid. And if it doesn't, they'll go after the named person. Doesn't work too dissimilarly from a promissory note. It's just more like a third-party insurance break your kneecaps kind of. No, I'm kidding. It's not that bad, but it's kind of like a, bail bondsman. They'll go after you if you don't pay it, and the bank won't have to deal with it because the surety company will, but not going to be commonly testable. We don't use that in North Carolina. So let me ask you a question here. This clause gives you the legal right, gives the lender the legal right to require full repayment of the loan once the borrower defaults. What did we call that? Yeah, this is the acceleration. You messed up, so your full balance is due and payable, right? It's because you defaulted. You didn't make a payment. You were in pre-foreclosure. You altered it without permission. Because of some default or something like that, they've sped up the maturity. You did have this much time. Now you no longer have it. The full balance is due and payable immediately because of a default or issue. It's called an acceleration clause. How about this one? This provision requires payment of the entire loan balance when the financed property is sold or transferred. There you go. This one is your alienation clause, also referred to as the due on sale clause. He didn't do anything wrong, but because you no longer own it, we need that loan paid off. That means the next person has to get their own loan. And I told you this being present means the loan is not assumable. In order for a loan to be assumable, it would have to lack this alienation clause. And I told you government-backed loans are prohibited from having the alienation clause. Now, let me kind of talk you through an interesting concept, if you will. Most often, folks, when we say cash sale, most of you are probably thinking that I mean somebody is purchasing the property with cash. And in the financing discussions, that doesn't necessarily mean just that. Right? Yeah, there is a cash purchase where somebody is purchasing the property with nothing but cash, while most people will put a down payment in cash and then borrow the rest. But at the end of the day, when we're talking about a cash sale, we just mean the old loan is being paid off in its entirety, right? Every deal is technically a cash sale because cash does come from the bank. So just don't get caught up on that. It's just one of those interesting things where, most people aren't paying in cash. They could. But even when they're borrowing some of the money, we very often call it a cash sale because the old loan is being paid off in its entirety, which means cash is being shelled out. And of course, there's going to be a new down payment and new mortgage, which would then result in a later cash sale. Again, don't get so caught up, though. It's not a very important note to mention here. Let me kind of go down a rabbit hole because this is where things get a little weird. More often than not, you all understand, buying a house in cash, actually like paying completely out of pocket in cash. You also understand that the vast majority of people put down a cash down payment and then borrow the rest. But these are not the only two ways that people can buy houses. We already talked about installment land contracts. There's also traditional seller financing called a purchase money mortgage. And there's even more unique, weird things like subject to and loan assumptions. Of course, a loan assumption would be, as I said, if there was a loan that did not contain an alienation clause and they met the same legal criteria or lending criteria, they could potentially assume somebody else's loan, but that's a little more complex. But let's talk about this one first. Subject to. It says, when a new buyer takes over a loan subject to the original owner's loan, the original owner maintains responsibility in the event of a default. This is a very dangerous thing in the real world, okay? Because what more often than not happens is let me find my pen here. There is the loan between, the owner and the bank, with this promissory note, and we'll call it the, seller. Well, let me do it this way. Between the bank and the current owner, aka the seller, has this promissory note. But what we're saying is subject to is basically there is a buyer who has now agreed to kind of come in and just make the payments. They haven't assumed the loan. So that means the seller is maintaining all of the responsibility still. They are still the ones in the eyes of the bank that is paying this loan. The reason why that this is so dangerous, folks, and this has been a very big thing in recent years from shoddy investors and, real estate gurus teaching people how to get rich, is trying to negotiate a subject to loan or a transaction And what they'll have the sellers do is they won't do anything with the loan, but they will have the seller sign a quitclaim deed, deeding the ownership to the buyer. The problem with that is most loans are not assumable. And so most loans contain the alienation clause that we just talked about. And so if you were to transfer the ownership sneakily without telling the bank to a new person, but leave the loan in the name of the seller, you just committed loan fraud. Because now you've triggered the alienation clause, because eventually the bank will find out, but you didn't ask them permission, and so that it's loan fraud, for lack of a better way of putting it. So subject twos are very dangerous because the seller maintains full liability. Loan assumptions are not dangerous, but they're not common either, because what we're saying is the buyer would come in, take over the loan that the seller had in place. It'd be in the name of the new buyer, and then of course the deed would also be in the name of the new buyer. The reason why these are not common is because nobody's giving you their equity, so you typically need a second loan anyway, or would have to pay cash to buy out their equity. Yeah, you may take over the $200,000 balance, but if it's a $400,000 house, you still got to come up with another $200,000, either in cash or from another loan. And of course, I understand that, just saying that out loud, some of you are probably like, what the hell is this man talking about? I get it. I know. These are not like crazy testable things, but they can show up. How about this question? True or false, after being foreclosed on by a lending institution, the lender has the right to file a deficiency judgment against the borrower. This is true, of course, understanding that the caveat is if they didn't get enough money. Just so we're all on the same page here. If they sell it in excess of what they were owed, they would have to give any surplus to the borrower. They cannot keep any money from the auction that is more than what they are owed. So if they sell it for less than what they're owed, sure, they could file a deficiency judgment. And the same thing would be true of a short sale as well. If they're agreeing to take less, doesn't mean they have to forgive and forget it. They could also do the deficiency judgment in that one also. Ugh. So here's probably where we're going to end up, spending the rest of our time is loans, folks. This is where these conversations should sound a little more familiar to you based on something different than some of the other ones we've had, should I say? Because, of course, lien theory states, title theory states, these are not things you're used to hearing in the real world. Conventional loans, VA loans, FHA loans, you've heard these before. You may not know exactly what they mean, but you've at least heard them. And so when we're talking about a conventional loan, folks, the biggest thing you need to know about a conventional loan is it is a completely private loan. It is a loan between the bank and the borrower. The government is not part of this at all. There is no government backing on these. Now, I'm not stating that, they won't be sold and purchased by quasi-governmental agencies in the secondary mortgage market. But what I mean is there's no government backing. There's no mitigation of risk. The lender is bearing all the risks in a conventional loan when you borrow money this way. And just like most of these other loans, these are based on loan-to-value ratios. And I told you the most common conventional loan-to-value ratio is an 80% LTV. In other words, most lenders like to see a 20% down payment on conventional loans. However, there are conventional loan programs with down payments as low as 3%. But let me explain something here. When you put down less than 20%, and folks, you need to memorize this number. When you put down less than 20% down payment, you are considered a much higher risk to the lender. And I'll show you why. And we'll just use, $400,000 as the example again. Let's say that you were doing an 80% loan to value ratio. That is borrowing $320,000, which means, folks, the other $80,000 is your down payment. You're putting in $80,000 of your personal money. That is a chunk of change. If you were doing a 97% loan to value ratio, it means you're only putting down a 3% down payment. Folks, I want you to see the difference in your down payment here, right? Even the loan amount aside, $400,000 times 3% down payment is $12,000. And so let me explain why it's a much bigger risk here. Folks, imagine that you lose your job or you have to change jobs and things get a little rocky and you're struggling to make the payments on your home. If you're struggling to make the $2,000 a month payment and you have $80,000 tied into this house, you're going to hire a real estate agent and you're going to sell the property to get your equity. If you're struggling to make your $2,000 payment and all you have is $12,000 in equity, 2, 4, 6, 8, 10, 12, 6 payments, and you will have already paid all the equity that you have in the property. So it's a lot more likely that you will just walk away from the house and not worry about getting it sold because you don't stand as much to lose versus, having to make that payment each month. So you're much higher risk. And because of this, 20% is the magic number, folks. If you put less than a 20% down payment, the bank is going to require you to have private mortgage insurance. Remember earlier in this class, I told you there are 3 types of insurances. There is your hazard or homeowner's insurance, there is title insurance, and there is mortgage insurance. Here's the third one, mortgage insurance. Now, folks, there is both just mortgage insurance and private mortgage insurance. When we're talking about a conventional loan, it is called private mortgage insurance because it is a private loan. And so I want you to understand what this mortgage insurance is. It is an insurance policy for the bank from a private mortgage insurance institution that helps minimize their loss if you default. In other words, this insurance policy does not cover the whole foreclosure if they have to foreclose. It basically kind of insures them from what you put down, 3%, 5%, 10%, and what they would have liked to have seen you put down, 20%. That's all this is. You have to pay for it as the borrower, but it benefits the banks. It is an insurance policy in case you default to minimize their loss because you didn't put a 20% down payment. Now here's the cool thing. Imagine that you put down a 10% down payment. You are going to have to pay private mortgage insurance. But then let's say 3 years later, your home has appreciated in value to where you have more than 20% equity in it now. As soon as you hit that 20% equity, the bank will drop this private mortgage insurance. You don't have to keep paying it once you have at least 20% equity. And so they don't ever do it automatically when it's from appreciation. If it's through like amortization where they know that you're going to be at 20% in 15 years, they will do that automatically. But if it appreciates, typically what you have to do is you have to call the bank and you have to say, I think I have more than 20% equity in my house. Will you drop the private mortgage insurance? And you have to send a formal request and they'll take it off. Sometimes they will have to order an appraisal to do it. Other times they will just do it. So that's kind of the cool thing about conventional loans is even if you have less than a 10% or less than a 20% down payment and you have to have this mortgage insurance, it can and will fall off when you're dealing with when you get to 20% equity. USDA loans, let me just put it this way. Government-backed loans, any kind of insurance that's on them never falls off. The only way to remove it off government-backed loans is to refinance. So, conventional loans, private loans. Lender bears all the risks. There's no government backing, no protections for the lender. And they are going to require you to have private mortgage insurance if you put less than a 20% down payment. I'm going to talk about this a little bit more in a second. It's talking about being purchased by Fannie Mae. There's what we call the secondary mortgage market, which is comprised of, the quasi-governmental agencies, Fannie Mae, Freddie Mac, and Ginnie Mae. These conventional loans are still purchased by some of these quasi-governmental agencies, and they would still have to meet underwriting guidelines to be purchased by them. And that's what it's saying. Conforming to the underwriting guidelines of these quasi-governmental agencies can be sold to them in the secondary mortgage market. If it was non-conforming, meaning did not meet these underwriting guidelines, they're not going to buy it. The best way I can equate these underwriting guidelines to you, it's like if I was to give you a recipe for a cake and I said, hey, if you make this cake exactly like this, I will buy it from you. And so you make it perfect every time, I'm going to buy this cake from you and pay you for it. But if you get it wrong, I'm not going to buy it. That's what underwriting guidelines are. They basically say it has to have this recipe, and if you meet this, we'll buy it. Now, just for clarification's sake, while we're sitting here talking about conventional loans, a lot of supplemental things like home equity lines of credit, home equity loans, things of that nature would be also under conventional guidelines, right? No government backing there either. The lender would bear all the risks on all of those. We are going to talk more about these things specifically down the road on like kind of what a HELOC is, at least in a nutshell. It's not something that's crazy testable, but they would all fall under the conventional guidelines of being completely private. Lender bears all the risks. Now, just to show you this, folks, because you've realized now, anytime I teach you a math concept, there is the potential for you to have to reverse engineer the math problem. Well, I told you, if we give you your loan to value ratio, right, you would take your loan amount or appraised value, whichever is lower, multiply it by your loan to value ratio to find your loan amount. In this one, we're trying to figure out what your LTV is. Folks, it's no different than what I've been showing you from the word go. Purchase price times LTV equals loan amount. So if you have your purchase price, and you have your loan amount, but what you don't have is loan to value ratio, just like reversing anything else, right? This unknown rate, you could divide by the purchase price on this side, and then do the same thing on the other side. So in other words, loan amount divided by purchase price gives you your LTV. So in this example, I just did an 80% one, right? $320,000 divided by $400,000 purchase price, 80% LTV. That's all this is showing you. Just reverse engineering it. Loan amount divided by purchase price gives us your loan to value ratios. Bridge says, do home equity loans typically require an appraisal? Depends. If they know for a fact that you've got crazy amounts of equity, some companies will waive it, depending on how much you're asking for. If you are not having crazy amounts of equity, or if you're asking for a lot, they typically are going to require an appraisal. Yeah. Now, of course, in this example, it's dealing with a 90% loan to value ratio. So if we're dealing with a conventional loan, that means that you would have to have PMI, or private mortgage insurance. And private mortgage insurance, folks, just as a piece of clarity here, there is typically an annual premium for your mortgage insurance that you would pay at closing. And then when we talk about your pity payment, when there's mortgage insurance, that's included in the I. So your pity payment would be principal, interest, taxes, insurance. That would mean homeowner's insurance and mortgage insurance if present. So a lot of times they would come out of your escrows. You would have to have a even more going into your pity payment each month to cover your mortgage insurance. But they're not going to make you do math questions like that on the test. But you will have to know what mortgage insurance is, and you may potentially have to do that calculation for a closing disclosure problem. So, conventional loan is a private loan. Lender bears all the risks. So then we switch gears and we talk about the first of the government-backed loans. Okay, the first of the government-backed loans. And that is an FHA loan. Now, folks, FHA stands for the Federal Housing Administration. Do not confuse it with the Fair Housing Act. Not the same thing. We'll talk about fair housing later, but FHA is the Federal Housing Administration. And so there's a video that I'll have you watch later that explains this in more detail, but you have to understand that once upon a time, houses were a lot cheaper than they are today. And the loan terms were a lot shorter. And as inflation happened and houses got more expensive and people were making money differently and homes were being financed for much longer periods of time, banks started getting real iffy about lending money to people who were not as well qualified buyers, and especially not getting it back for 30 years. And so the way that the government counteracted the risk that the banks weren't really willing to take was by helping protect the banks if these not as qualified borrowers defaulted. And so when I say not as qualified, these are a little more lax, right? They have less strict loan to value ratios. They do not require as strict of a credit score. And FHA loans only require a 3.5% down payment. And so there is the easiest way to think about this, folks, is this is what we call an FHA insured loan. Basically, the Federal Housing Administration provides the insurance. There's still a payment for it. There's still a cost to it, but it's generally cheaper than the private mortgage insurance for the borrower because it is kind of subsidized by the government, going to the government. And so that's why we call these FHA insured loans. The government is not writing a check. The government is providing the insurance that if the borrower defaults, we've got this insurance policy in place that yet again helps cover the spread between the 3.5% down payment that the borrower put down and the 20% the banks would have liked to have seen. Now understand, the Federal Housing Administration is not the one lending the money. They are simply providing the insurance. The banks are still lending the money. The banks still set the interest rates. All of that's still true. And of course, this is a government-backed loan, and so this would be prohibited from having what two clauses? Alienation clause, aka the due on sale clause. No, not the acceleration. Every loan has the acceleration clause. Yeah, the prepayment penalty clause. Government-backed loans are prohibited from having the prepayment penalty clause, and they're prohibited from having the alienation clause, which means all government-backed loans are assumable. And you cannot be penalized for prepaying them early, paying them off early. But every loan has the acceleration clause. If you screw up, you're going to have to pay the full balance right now. So there is a couple other things to be aware of, and I'm not sure exactly how much of this is testable, but folks, because the government has some skin in the game, the appraisals are a little more strict. You have to use an FHA approved appraiser, number one. Okay, so they have to have certain training and certifications to be able to do appraisals. Why? Because the FHA appraisers are going to look at the condition of the property a little more thoroughly than a conventional appraiser would. Because the government doesn't like to have a high risk when they're insuring it. And so just to put it in some perspective, if the property had shaky handrails, if it had damaged siding, if it was missing carpet, they may not finance it. They typically have standards of the say, okay, if something's wrong, they may not finance it. And so you would not really be able to use one of these in like a distressed or semi-distressed property, because with these issues, they're going to say, no, we're not funding that. It's too risky for us. Or GFCI issue, yeah, maybe. So FHA insured. And so, folks, this is not called private mortgage insurance. This is just called mortgage insurance because it's not private. It's through the Federal Housing Administration. Now, here's the other piece that I just told you a moment ago. You only put 3.5% down on an FHA loan, which is great, right? That is a very affordable down payment. These are great loans for a lot of, first-time home buyers because they are, a little more lax in the lending criteria. The downside of these government-backed loans, though, is let's say that you purchase a home with a 3.5% down payment. The market goes nuts. Your house appreciates. And now, just like that, you've got 30% equity. The mortgage insurance premium never goes away in an FHA loan. If you maintain it for 30 years, you'll be paying your mortgage insurance premium for 30 years. The only way to remove the mortgage insurance on an FHA loan, or any of the government loans for that matter, if it was present, and you'll see what I mean in a minute, would be to refinance to a conventional. Right? That'd be the only way. Does not fall off. So as I said, because it's a government-backed loan, no prepayment penalty allowed, no alienation clause allowed. Points and interest rates and all that stuff are set by the lenders. The lenders are the ones lending the money, not the Federal Housing Administration. Lead-based paint disclosure required on houses built prior to 1978. Well, folks, that's true under the Federal Lead-based Paint Hazard Reduction Act of 1992. What we mean is they will not fund it without seeing that lead-based paint disclosure. The lender will want to see it before they fund it. Yet again, to minimize their risks as the insurer on this. And then the last note says owner-occupied. FHA loans are for owner occupancy. You cannot use these to purchase an investment property. So you would have to be for owner occupancy. Now, there are a lot of different programs. There is, there's a list, and I'm not going to get into that tonight because we don't need to do that. But there is, loans available for regular houses, but there's also an FHA program for a fixer-upper, if you will. Why can't I think of the name of it? It is called it's like the 203K rehabilitation loan is what it's called. But basically, they would finance the purchase of a distressed property and give you money to renovate it, but they're kind of complex. So there's like 12 different FHA programs, but they're all intended in some way, shape, or form for owner occupancy. They're not designed for investment properties. If you were to purchase a property and tell the bank that you were buying it to live in, and then you turn around and turn it into an investment property, that's called loan fraud. And we're going to get into this. Loan fraud is punishable by fines up to $1 million and up to 30 years in jail time. 203K. There you go. That's what I said, right? I think I got it right. 203K. Yeah, the rehab one. How about this question before we go further into the other government-backed loans? And thank God you only have a little bit left tonight, because I know it's hurting. I know. I'm aware. The formula for calculating your loan-to-value ratio is what? Don't panic, Ashley. You were right. I was just waiting to see if anybody else helped me out on it. So, yeah. Loan amount divided by your sales price would be how you calculate your loan-to-value ratio. There you go. What they said. I'll take it. Folks, the other one that we always talk about in the government-backed loans, and there's technically one more, but VA. Okay, VA stands for Department of Veteran Affairs. Okay, so FHA loans are arguably for anyone, but you do have to meet the criteria of debt to income ratios and things of that nature. A VA loan is not for anyone. A VA loan is to veterans, spouses of veterans, retired, active duty. You have to be military to get a VA loan. Honorably discharged. If you were dishonorably discharged, you're not eligible anymore. But this comes back to your eligibility through the Department of Veteran Affairs. And so you would have to get your certificate of eligibility from the DVA and be able to look at your entitlement and the way this works. Now, understand, when we talked about FHA, it was FHA insured. We call this VA guaranteed. Why? Because the Department of Veteran Affairs is basically your insurance policy, but they're not calling it an insurance policy. They're basically stating if you default, they will cut the check to the bank for the 20% that they didn't get. And so that's the difference. It's not an insurance policy. They are guaranteeing that they will cut the check to make up the difference of whatever the bank didn't get. Not full coverage. They're not buying the house, but it's to help cover that spread because VA loans are 100% loan to value ratio. Folks, what that means is it is the highest loan to value ratio that can exist. You are borrowing 100% of the purchase price or the appraised value. So if you're purchasing a $400,000 house, you can borrow all $400,000. You don't have to put a down payment. So for that reason, this is an exceptionally cool loan for veterans and people who are eligible for this. Now, let me make something abundantly clear. They still have to qualify to borrow money. That is the biggest misconception. People think, oh, no fair, because they're a veteran, they just get to buy a house. No, they still have to have income and assets adequate to buy it. Let's say that you were in the military for 30 years, the military may guarantee a purchase up to $2 million. But what they're only covering is that 20% spread. But if you don't make enough money in civilian life now that you're out or have enough cash, you're not getting a $2 million VA loan. So your entitlement, there is no cap. You could potentially have crazy amounts of entitlement, depending on how long you're in there. But you still have to qualify, folks. So if you don't make enough money, you're not going to get a loan. That's just all there is to it. So the Department of Veteran Affairs is, Anthony, I don't know if it would have helped you that much. I mean, it just depends. So yet again, the VA is not typically lending the money. Now, folks, it says the VA most often does not build homes or make the loans. It's typically the lenders. The reason why we say that is in some unique circumstances where maybe there is a property where a lender is not around or not available, they occasionally will actually lend the money to their veterans. Not common, but there are extreme circumstances where they will actually lend the money. It's not common though. That's why it says most often does not. Typically it's the bank. The VA is just guaranteeing the loan that if this borrower defaults, they will cover that 20% spread that they didn't get versus the $0 down payment that they did put down.